Welcome to Farmtips Diary. Higher interest rates transform borrowing from a tool for growth into a trap for the unprepared. When rates climb from 3% to 7%, loan payments nearly double while the assets being financed generate the same income as before. But across every rate environment, some farmers successfully leverage debt to expand and modernize, while others overextend and struggle. This is the story of how to navigate borrowing in high-rate periods, when refinancing makes sense, and how emerging funding sources can reduce your dependence on conventional loans. What rising rates really mean. Understanding interest rate impacts beyond simple payment increases reveals why rates fundamentally change borrowing. Strategy and what costs farmers actually face when rates climb. A $500,000 equipment loan at 3% over 7 years costs roughly $6,500 monthly. The same loan at 7% costs $8,600 monthly, a $2,100 or 32% increase. Over 7 years, total interest paid jumps from $47,000 to $221,000. This isn't marginal difference, but fundamental transformation of economics. Fixed versus variable rate debt creates divergent outcomes during rate increases. Farmers who locked in 3% fixed rates before increases are protected, their payments unchanged. Those with variable rates or needing to borrow now face dramatically higher costs. This timing luck creates massive economic disparities between otherwise similar operations. Debt service coverage ratios determine borrowing capacity. Lenders typically require farm income to exceed debt payments by 20 to 25%. When rates double, the income needed to qualify for equivalent loan amounts also increases substantially. A farm that could borrow $500,000 at low rates might only qualify for $300,000 at high rates, despite unchanged profitability. Asset values decline when rates rise, affecting borrowing capacity. Land and equipment values typically fall because buyers can't afford previous prices with expensive financing. This creates negative equity situations for recent borrowers and reduces available collateral for new loans. Farmers find themselves with less borrowing power exactly when borrowing costs more. The psychological impact matters. Higher rates discourage growth investment even when projects remain economically viable. Farmers accustomed to cheap money hesitate when faced with 7 or 8% rates, viewing them as prohibitively expensive. This psychological barrier delays necessary investments, sometimes worsening competitive position. Operating loan rates climbing affects daily cash flow. Many farms use lines of credit for seasonal working capital. When these rates double, carrying inventory or waiting for crop sales becomes much more expensive. This hidden cost strains cash flow even without long-term debt changes. The strategic insight is that high rates don't just make borrowing expensive. They reduce asset values, shrink borrowing capacity, strain cash flow, and create psychological barriers that alter decision-making. Navigating this environment requires understanding all these dynamics, not just focusing on interest costs. When refinancing makes sense, conventional wisdom says refinance when rates drop, but the reality is more nuanced. Sometimes refinancing makes sense even when rates increase, depending on individual circumstances and loan structures. Refinancing to extend terms reduces monthly payments despite higher rates. A farm with 5 years remaining on a 6% loan might refinance to a new 15-year loan at 7%. While total interest increases, monthly cash flow improves, providing breathing room during tight margin periods. This strategy sacrifices long-term cost for short-term survival. Consolidating multiple loans simplifies management and sometimes reduces total payments. A farm with several equipment loans, an operating line, and a land payment might consolidate into single financing, even if the rate is higher than some existing loans. Eliminating the highest rate debts and reducing total monthly obligations can improve cash position. Refinancing variable rate debt to fixed locks in certainty. If rates are 7% now but expected to climb higher, converting variable to fixed prevents future increases. The psychological value of predictable payments and eliminating worry about further rate hikes justifies paying somewhat more than current variable rates. Accessing equity for strategic investments sometimes justifies refinancing. A farm that purchased land years ago at 3% might refinance at 6% to access appreciated equity, using proceeds for solar installation or irrigation improvements that reduce operating costs. If the efficiency gains exceed the increased interest cost, refinancing improves overall economics. The calculation requires comparing all costs: new interest rate, origination fees, appraisal costs, prepayment penalties on existing loans, and opportunity costs of alternative strategies. Many farmers focus only on rate differences, missing significant closing costs that eliminate apparent savings. Total cost over the life of loans must be calculated accurately. Break-even analysis determines if refinancing makes financial sense. If refinancing saves $200 monthly but costs $15,000 in fees, break-even occurs after 75 months or over 6 years. If the farm expects to sell or pay off the loan before break-even, refinancing loses money despite lower payments. Lender relationship considerations matter. Refinancing away from a supportive lender to chase marginally better rates might backfire during future stress when the original lender would have worked with you but the new lender won't. The value of established relationships sometimes exceeds rate savings. The strategic principle is that refinancing decisions should be based on total lifecycle cost analysis, considering fees, timing, and relationships, rather than just comparing interest rates. Sometimes paying more to refinance improves your situation. Sometimes cheaper rates cost more overall. Green finance and sustainability incentives, emerging funding sources specifically supporting environmental improvements, create opportunities to finance upgrades at below market rates or with grants that reduce total borrowing needs substantially. USDA REAP grants cover up to 50% of renewable energy and efficiency project costs. This means a $200,000 solar installation might receive a $100,000 grant, requiring only $100,000 financing. Even at 7% interest, financing half the cost is far more manageable than borrowing the full amount at lower rate. State-level green financing programs offer reduced interest rates for environmental projects. Several states provide 2 to 4% loans specifically for solar, water efficiency, or soil health improvements. These programs aim to encourage sustainable practices, subsidizing interest costs through state environmental budgets. Conservation program cost shares through NRCs reduce upfront capital needs for practices like cover cropping, riparian buffers, or water management infrastructure. While not loans, these payments reduce how much farmers must borrow to implement conservation practices, lowering total debt service. Carbon credit programs provide upfront payments for adopting practices that sequester carbon. These payments can fund implementation costs, potentially eliminating borrowing needs entirely for some projects, while carbon markets remain evolving. Several programs now offer substantial payments to farms adopting regenerative practices. Property-assessed clean energy programs in some regions allow financing energy efficiency and renewable energy through property tax assessments. These mechanisms often offer longer terms and better rates than conventional loans, while not appearing on credit reports as debt, preserving borrowing capacity for other needs. Community development financial institutions sometimes provide mission-driven lending at below-market rates to farms in underserved areas or implementing social and environmental benefits. These specialized lenders prioritize impact alongside financial returns, creating opportunities farmers might not find through conventional banks. Investor partnerships for specific projects allow farms to implement improvements without traditional debt. A farm might partner with an investor who pays for solar installation in exchange for energy cost savings or carbon credits. The farm gets the efficiency benefit without borrowing, while the investor gets returned from savings or credits. The strategic approach is layering incentives. A farm installing solar might capture 30% federal tax credit, 25% REAP grant, 3% state loan, and investor partnership covering remaining costs. Creatively combining programs minimizes conventional high-rate borrowing while implementing valuable improvements. Building stronger loan applications. In high-rate environments where lenders are more selective, presenting compelling business cases becomes essential for securing financing at reasonable terms. The quality of loan applications directly affects approval odds and rates offered. Detailed financial projections showing clear paths to profitability and debt repayment are mandatory. Lenders want to see realistic cash flow forecasts demonstrating the farm can service debt under various scenarios, including pessimistic cases showing viability even if yields drop or prices decline, builds credibility. 3 to 5 years of accurate financial statements provide baseline for projections. Lenders trust applicants with documented histories far more than those with rough estimates. Farms using professional accounting and farm management software present better than those with handwritten ledgers or informal records. Clear explanations of how borrowed funds will be used and what returns they'll generate are crucial. Instead of buying equipment, specify purchasing 300 horsepower tractor to replace aging 200 horsepower unit, enabling working 500 additional acres under lease at $150 per acre net margin, generating $75,000 additional annual income against $60,000 annual debt service. Collateral documentation, including current appraisals, equipment titles, and property surveys strengthens applications. Lenders can't approve what they can't value. Providing comprehensive collateral information upfront accelerates approval and potentially improves rates by reducing perceived risk. Personal credit scores and history affect farm loan terms more than many farmers realize. Lenders view personal financial responsibility as indicating business management quality. Ensuring personal credit reports are accurate and scores are maximized before applying improves outcomes substantially. Business plans articulating strategy, market analysis, and competitive positioning demonstrate professional management. Lenders prefer financing farmers who think strategically rather than those just reacting to circumstances. A coherent business plan differentiates professional operations from hobbyists. References from suppliers, buyers, and other lenders provide third-party validation. Positive references from credible sources reduce lender concerns about reliability and business acumen. Building and maintaining these relationships before needing them creates advantages when applying for financing. Professional presentation matters. Loan applications should be cleanly formatted, well organized, and grammatically correct. This signals professionalism and attention to detail that lenders associate with reliable borrowers. Sloppy applications raise red flags, regardless of underlying financials. The principle is that lenders in high-rate environments can be selective. Farms that present as low-risk professional operations get approved at better rates than those appearing marginal or poorly managed, even if underlying economics are similar. Real examples of strategic borrowing abstract principles matter less than seeing how actual farms successfully use debt to fund improvements even during high-rate periods, demonstrating that smart borrowing remains possible when fundamentals are sound. A Nebraska grain farm borrowed $380,000 at 6.5% to install center pivot irrigation on 4 acres, previously dryland acres. The irrigation increased corn yields from 120 bushels per acre to 190 bushels, adding 70 bushels, or roughly $340 per acre, in gross revenue. Annual net revenue increase of $115,000 easily covered $35,000 annual debt service. Despite high rates, the return on investment exceeded 25% annually. The farm secured financing by presenting 10 years of yield records showing dryland volatility from drought, demonstrating that irrigation would stabilize income and reduce lender risk. They also obtained NRCS cost share covering 30% of installation costs, reducing borrowing needs. The combination of compelling economics and reduced capital requirements convinced a lender despite tight credit conditions. A California vegetable farm financed a $260,000 solar installation at 7% interest. The system eliminated $42,000 in annual electricity costs. After capturing 30% federal tax credit and 25% REAP grant, net cost was $117,000. Annual savings of $42,000 paid off the loan in 3 years, after which the farm enjoyed free electricity for decades. Despite the high interest rate, the short payback made the project extremely attractive. The farm strengthened their application by including 3 years of electricity bills documenting actual costs, engineering studies confirming projected solar production, and financial projections showing debt service covered entirely by energy savings. The lender viewed this as essentially zero risk, since even if farm income declined, energy savings guaranteed payment ability. A Wisconsin dairy borrowed $520,000 at 6% to install robotic milking systems. Labor costs dropped by $85,000 annually while milk production per cow increased 8%, adding $65,000 in milk revenue. Total annual benefit of $150,000 exceeded the $44,000 debt service substantially. The investment paid for itself in 5 years while reducing the physical demands on an aging farmer couple. Critical to approval was demonstrating the labor crisis threatening the farm's viability. The farmer documented difficulty hiring reliable workers and showed that the robots solved an existential problem, not just providing an upgrade. Lenders approved because failure to invest was riskier than borrowing at high rates. A Texas cotton farm used a 3.5% state green loan program to install drip irrigation replacing flood systems. Water use dropped 40% while yields increased 15%. The low interest rate was specifically available for water conservation, making the project economically viable where conventional 7% financing would have been marginal. The farmer spent 3 months researching funding programs before applying, identifying the state program that many farmers didn't know existed. This persistence in seeking creative financing sources made the difference between implementing the improvement and deferring it indefinitely. These examples share patterns. They invested in projects with clear, quantifiable returns. They presented strong business cases documenting benefits. They creatively layered incentives to reduce capital requirements. And they viewed borrowing strategically as tools for solving problems or capturing opportunities, not just as ways to buy things. Your funding pathway checklist navigating the complex landscape of farm financing requires systematic approach, examining all options rather than defaulting to conventional bank loans. This checklist provides framework for exploring alternatives. Start with grants and cost-share programs requiring no repayment. Check NRCS state agriculture departments, soil and water conservation districts, and utility efficiency programs. Apply for these first since they reduce or eliminate borrowing needs. Investigate low-interest government-backed loan programs including FSA direct and guaranteed loans, state agriculture development authorities, and local economic development programs. These often offer better rates than commercial banks and more flexible terms for beginning or underserved farmers. Research tax incentives including federal investment tax credits, bonus depreciation, and state-level credits. While not loans, these reduce after-tax costs of investments, improving economics and reducing financing needs. Explore energy-specific programs for solar, efficiency, or renewable projects including USDA, state renewable energy programs, utility incentives, and property-assessed clean energy financing. These sources often provide better terms than general-purpose loans. Consider cooperative financing through farm supply cooperatives, farm credit system institutions, or farmer-owned lending cooperatives. These member-owned entities often provide more favorable terms and more flexibility during difficulties than conventional banks. Examine vendor financing for equipment and technology purchases. Manufacturers and dealers sometimes offer promotional rates below market, subsidized to move inventory. Terms might beat bank financing substantially. Investigate impact investors and mission-driven lenders seeking both financial returns and social or environmental benefits. Organizations supporting sustainable agriculture might provide capital unavailable from conventional sources, build relationships with multiple lenders before needing financing. Having established credit lines, loan history, and familiarity with several institutions creates options and negotiating leverage when rates or terms differ. Maintain excellent documentation and financial records continuously. When opportunities arise, being ready to apply immediately rather than spending months assembling documentation allows capturing favorable programs or rates before conditions change. The principle is that farm financing is diverse and evolving. Farms limiting themselves to single conventional lenders miss opportunities for better rates, more favorable terms, or grants reducing borrowing needs substantially. Strategic borrowing requires research and creativity beyond simply visiting the local bank. Recap: rising interest rates don't just increase loan costs, they reduce asset values, shrink borrowing capacity, and create psychological barriers affecting investment decisions. Refinancing sometimes makes sense even at higher rates when extending terms improves cash flow, consolidating simplifies management, or accessing equity funds. Strategic improvements, green finance programs, including USDA REAP grants, state environmental loans, conservation cost shares, and carbon payments provide below-market financing or outright grants, substantially reducing borrowing needs. Building stronger loan applications through detailed financial projections, professional documentation, clear explanations of fund use and returns, complete collateral information, and strong personal credit dramatically improves approval odds and terms. Real farms successfully borrowed during high-rate periods by investing in projects with quantifiable returns like irrigation, adding $115,000 annual income, solar eliminating $42,000 electricity costs, or robotics saving $85,000 in labor. A systematic funding checklist examining grants, low-interest government programs, tax incentives, energy-specific financing, cooperative sources, vendor options, and impact investors reveals opportunities beyond conventional bank loans. If these borrowing strategies gave you practical pathways for funding your farm's next upgrade, give this video a like and share it with anyone navigating farm financing decisions. Subscribe to Farmtips Diary for more insights on building financially resilient operations. Hit that notification bell so you never miss strategies that could improve your access to affordable capital. Thanks for watching, and we'll see you in the next one.